Crude oil futures are edging lower on Tuesday at the start of an OPEC Plus ministerial committee meeting designed to look at adjusting plans for oil supply cuts next year as the coronavirus pandemic continues to drive down demand. According to the report, Joint Technical Committee concluded that oil demand would grow by 6.2 million barrels per day in 2021, compared to its previous estimate, which called for growth of 6.5 million barrels. JTC has looked at various scenarios on altering the deal on output cuts and the impact each scenario would have on reducing OECD inventories in line with the 5-year average. Scenario A. The base case adopts modified data from the November 2020 OPEC monthly report, in particular on oil demand. Scenario B. This alternative scenario assumes higher contractions for world oil demand and non-OPEC supply in 2020 and lower growth for demand and non-OPEC supply in 2021. Scenario C and D assumes extending current crude output cuts using the base case framework to the end of the first and second quarter 2021. If current production cuts were extended for 3 more months, OECD commercial inventories would be higher by 73 million barrels compared to the 5-year average in 2021. A 6-month extension would put material pressure on inventory levels, and they will be just 21 million barrels higher than the 5-year average. While the 6-month extension of current production cuts will certainly help the oil market, OPEC Plus will likely fail to get all members to comply with such a deal. The budgets of OPEC Plus countries are heavily reliant on oil revenues, and many producers want to boost their exports as soon as possible. In addition, some OPEC Plus countries may be unhappy with the massive increase of Libya's oil production, which has already reached 1.2 million barrels. Libya is exempt from the production cut deal due to the civil war and plans to boost its production to 1.7 million barrels, potentially taking market share from other OPEC members. This situation creates significant tensions which make a 6-month extension of current production cuts an unrealistic scenario. Yesterday, oil made an attempt to settle above the $42 level after Moderna reported that its coronavirus vaccine was 94.5% effective. Today, oil is losing ground on fears that the situation with coronavirus will get worse before it gets better, putting additional pressure on oil demand. The key question is whether oil traders will be ready to shrug off virus worries and focus on the longer-term outlook for oil. While OPEC Plus will likely extend its production cuts for the first quarter of 2021, inventories will remain at elevated levels until demand for oil fully rebounds, which will not happen before mass vaccination. At this point, it looks like oil has found strong support near the $40 level, but it will likely need additional positive catalysts to get to the test of the recent highs at the $43 level.